We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome back to The Long-Term Investor, proud member of the Retirement Podcast Network. In this episode, PIMCO's David Braun returns to the show to explain some important fundamental concepts that really unlock the potential of bonds, in my opinion. David has been with PIMCO for 15 years, and he's a U.S. generalist fixed income portfolio manager in the New York office. So I asked him to join me on the New York Stock Exchange and share some of his tremendous experience in the investment and risk management areas. We cover all sorts of ground. We cover the role of core bonds in a portfolio, the impact of rising yields and how that should reset our expectations for bonds. We also touched on active versus passive management because it's a little different in bonds than it is in stocks. And finally, I was super interested to hear David's opinion on the impact of the U.S. national debt on bond investors. As always, you can find detailed show notes and links to all the resources mentioned in this episode by visiting thelongterminvestor.com. And now, here is my conversation with David Braun. David Braun, welcome back to The Long-Term Investor. Thank you so much for joining me here on the floor of the New York Stock Exchange.
Thanks for having me, Peter. Super excited to be here.
Well, I would try to take you to a bond exchange, but you have bond ETFs here. PIMCO has stock ETFs. But while that advancement seems obvious, when I started my careers in June 2007, and the RIA I was at, we traded individual bonds for people. We bought lots of mortgage-backed securities, and it was really their sweet spot. And over time, the development of bond funds seemed like the obvious choice for reasons that I could easily say, but I don't want to steal your thunder. When you talk about the management of a fund, what do you feel like are the big advantages of owning a fund of bonds as opposed to owning a portfolio of individual bonds that you're managing on your own?
Yeah, so look, I get it. A lot of retail investors like that security of seeing their bonds, buying their bonds, owning them. They get to clip the coupon income. They get to control when they sell them, thus realizing a taxable gain or loss event. And it just kind of feels nice. But that strategy comes with risks or with trade-offs. And some of those trade-offs are quite expensive in our mind that could lower your return and actually add to your risk. So first, let's start with the bond market itself. It trades over the counter, unlike a stock market. It's less efficient. So what that means is if you or one of your clients goes and buys a share of a stock that's in the S&P 500, they're probably paying the same price that a large institutional investor would pay because it's an exchange-traded, high-efficiency market. The bond market, I guarantee if they go buy a bond, they're probably paying more than a big institutional investor like PIMCO would pay for that bond just because of the frictions and rigidities in there.
And they're not even going to see that they're paying more because it gets baked into just a lower yield, right?
I mean, by the opaque, it's kind of like a transaction cost that's very elusive to understand. Second thing is the information asymmetry. Like everything on the S&P 500, they file the same financials. It's hard to garner a big information edge there. On the bond market, just take the Bloomberg aggregate. There's something like 13,000 individual CUSIPs in their bonds. So there's a big information asymmetry where an active bond manager like us can get an edge by getting more information than a retail investor. Next, on the risk side, this is important. Unless you're really high net worth, deploying tens of millions of dollars in the bond market, you're probably going to be stuck with lumpy positions, concentrated positions. What that means is if you get a call wrong and you get a credit that goes south, it could leave a big disproportionate size hole in your portfolio versus an actively managed bond fund manager that's going to do prudent diversification. The final thing I want to say is, again, unless you're a massive individual with a lot of money, you're going to be stuck trafficking in the most generic bonds out there. So treasuries, agency mortgages, and then the most liquid corporates. And in our mind, the more generic a bond, oftentimes what we observe is the less spread on those bonds because everybody and their brother can buy them, right? So kind of this juice has been squeezed. There's not a lot of yield left. We like to go where there's opportunity, where bonds aren't trampled over, aren't all the juice squeezed out of them, and we get a higher spread and maybe even a more attractive risk-reward profile. But look, we get it. Some investors really want that. So we try to partner with them. At PIMCO, we got what we think is an industry-leading investment engine. And we want to deliver that to folks. If they want their own bonds, we can run a laddered portfolio for them. We can run a separately managed account with individual line items in there. But again, it comes to those trade-offs I just mentioned. We also have a hybrid product that a couple of us in the industry have, where half your investment is CUSIP level bonds, and the other half is a 40 Act mutual fund that's kind of a completion fund. So that's where we get the more off the run, less generic securities, more yieldy securities, and you glue those together, and you're close to if you bought a fully active managed bond fund. And then finally, if you're ready to step outside of seeing your own bonds, we would promote buying an actively managed bond ETF or mutual fund. That's where we can deliver the most value to our clients and investors.
Well, and I feel that people who own individual bonds did so from a place of that was the only option once upon a time. And even as I think about the development of product in the fixed income space, it's gotten so much more dynamic and intelligent, where it used to be, if I am an investment decision maker at my firm, I need to decide when to extend duration or when to pull back on credit exposure. Whereas now, there are these core funds that can really get you that broad market exposure, own thousands of bonds, and sort of take that decision-making process out of the advisor's hands and give it to somebody who does have the deep expertise. So in that line of thought, I mean, your feelings of core bonds, I mean, what is the role that typically plays in a portfolio? What is the importance of the exposure?
Yeah, so what core bonds means to folks might be different, but I'll keep it simple. Core bonds to us means U.S. public securities that are relatively modest in duration, so like 5 or 6 year duration, high quality investment grade, and diversified. The most bellwether core index out there is the Bloomberg U.S. Aggregate Index, Bond Index. It's about 45% treasuries, 30% investment grade corporates, predominantly U.S. issuers, and then 25% Fannie, Freddie, Ginnie, agency guaranteed mortgages. That's what most people would call core. And that bellwether benchmark is what's out there. So when we think about the role of core bonds, which I think was the genesis of your question, bonds have been dragged through the mud the last few years, right? And let's talk about this. And I know you and I did one of these a few years ago. So why do you own bonds? You remember, why was the 60-40 founded? You own bonds in the 40, you're 60-40, to offset your equity risk. So bonds are a store of value, capital preservation. That's the first reason. Second reason is they kick off income. And then the third reason is, at least historically, they were negatively correlated with stocks. So they provide insurance. If your stocks are going down, your bonds are probably going up and vice versa. Now, let's walk down the last 4 years and we'll show how none of those three really worked, and therefore bonds have a bad reputation right now. But we think people are looking backwards, not forwards. So first, talk about the capital preservation. 2022, when the Fed started hiking, how'd capital preservation work out for people? Not well. Bonds generated their worst ever loss. The Bloomberg U.S. Aggregate had its worst ever drawdown in 2022. No surprise, the Fed started at 0, had to hike all the way up to 5.5%, bonds got hammered. So capital preservation didn't work. Talk about income. 2020, 2021, the U.S. Treasury bottomed out at 50 basis points, 0.5% in August of 2020. That was actually attractive. German bonds, Japanese bonds were negative yielding. So people were like, well, there's no income on bonds left. And that's what we learned in 2020, 2021. And then finally, that negative correlation. Ever since COVID hit, the Fed did its quantitative easing, we did fiscal stimulus, both bonds and stocks, the correlation shifted positive. For the first 18 months or so, the correlation was positive and they both went up, right? We're doing all that stimulus, bond funds went up, stock funds went up, great. Then 2022 hits. By the way, nobody complained when they both went up, right? And then 2022 hits and the Fed has to hike and the correlation stays positive, but both bonds and stocks go down. Everybody complains 60-40 is broken. That's the history. That's why bonds have a somewhat tarnished reputation now. But people need to look at where we are today and where we're going. Right now, this fight against inflation, we're still in a little bit. It's almost largely conquered, but it has caused a generational reset higher in yields. You look at the yield of the ag, 4.5%. Any active manager should be able to get you 5.5% or thereabouts. And then if you move out in the credit risk spectrum, more of a multi-credit, like our income fund, that's more like 6.5%. So 4.5, 5.5, 6.5, those are pretty attractive yields. In fact, you got to go back almost 20 years to find the ag yielding levels like that. So very attractive. Second thing is, we think that correlation is back, okay? Because look what happened. A couple months ago, we had the yen carry trade blow up. What did people do? They bought bonds. Bonds rallied like crazy. So we think that negative correlation, now that the Fed is normalizing policy and not kind of manipulating the markets by either stimulating or by inflicting pain on it in the inflation fight, Fed's going to get out of the way, and we're going to have willing buyers and sellers dictate the prices of stocks and bonds and the relationship, and we're starting to see that positive or negative correlation come back. And then finally, capital preservation, just do bond math, right? We're at 5% type yields. You need a huge rise in rates to get a negative return again. The problem with 2022 is we started with like 1% yield on the ag. So any rise in rates was going to rip through and tidal wave the yield that you were getting. Now we've got nice tailwind from that yield that should propel us forward. Another thing I'd say is, we get this a lot. I don't know if you and your advisor are getting this, but should the weights of 60-40 be static? And we would argue no. Just like any investor, you have to figure out what's your long-term goals and strategic asset allocation, but also what's priced in right now. And when we look at a market where growth is clearly slowing, like the US grew in 2023, slightly north of 3%, we're probably gonna grow north of 2.5%, 2.6% in 2024, depends on how the fourth quarter comes in. And then next year, we're saying we're gonna grow more one handle, like 1.7, 1.8%. So that's about our potential, but that's rapidly shrinking from where we grew the last 2 years. And you have to recognize that when you're growing slower, there's less room for error, meaning recession probabilities have to be rising. If you're growing at 3%, the economy can handle a couple body blows and stay positive. You're growing at 1.7, you get a few hiccups in the economy, you can easily go to recession. So you got a slowing economy, rising recession risks, bonds are priced the most attractive they have in 20 years, and then stock valuations are at all-time highs. So we might even argue, if you want me to get a little provocative here, that maybe the weights on 60-40 need to be flipped. Maybe 60% in bonds, given the backdrop of the economy I just mentioned, the starting yields, and the starting stock valuations. So that's kind of a view we have right now.
Well, it's interesting to unpack some of the things that you were talking about. When I think about 2022, worst bond market on record for the US aggregate bond index, one of the things that happened at the beginning of 2024 is that the market was pricing in all these Fed rate hikes far more than what we're going to have ultimately gotten. And when the Fed sort of said, hey guys, we're not going to be hiking rates that much, there was a big jump in yields at the beginning of the year, but the starting yield was higher. And so it offset those losses. And I feel like so many bond investors had been afraid of rising rates because they cause price declines. But now that yields are higher, there's a little bit more cushion there. And as you note, with yields being more attractive than they've been in 20 years, there are some people who now have to think a little harder about where they go on the risk spectrum with their stock bond split and with what they do in their portfolio. But the one thing that is probably most interesting to me, and it's something that took me a very, very long time to appreciate and understand, is that I think a lot of my listeners would say, hey, low cost indexing all the way, no matter what. But indexing in bonds is a very, very different thing than indexing in stocks. How is it that you explain the difference between active management in the bond market, relatively speaking?
Yeah, so first, the debate between passive and active has been going on. It's kind of like debating politics or religion, right? But look, you asked a guy from PIMCO here, so I'm going to advocate right? So look, we firmly believe in active management. Like we don't have a whole bunch of passive products, so we don't talk out of both sides of our mouth. We believe in the bond market for a lot of those reasons we just talked about, the inefficiencies, the opaqueness, the over-the-counter nature of it, that active management does work. You go to our website, PIMCO.com, we have papers called Bonds Are Different that show, yes, in large cap active equities, the majority of active managers do not beat their passive peers net of fees. Something like only 25, 30% of them do. On bonds are different, it's flip-flopped. Our data shows not just PIMCO funds, but the universe of active ETFs and mutual funds in bond land, it's almost the opposite. 75 to 80% over 5, 10-year, even longer periods have beaten their passive peers net of fees. Now, why is that, right? So the data says, hey, something's different here. It goes back to a lot of those inefficiencies I mentioned before, but I'll elaborate on a couple more. So again, go look up Bonds Are Different, get the data. But here's why. First of all, the bond index is inherently hard to replicate. Again, S&P 500, it's 500 stocks.
Right.
It turns over 4 or 5% a year, or maybe 10 or 20 names drop out and new ones come in. The Bloomberg aggregate is over 13,000 individual bonds, and about 25 to 30% of them drop out every year. So you're inherently chasing a more complicated index to replicate, and it's got much greater velocity of turnover. Second thing, that information edge I mentioned, right? There's a lot of bonds that aren't even in the index that an active manager goes shopping for and put in a portfolio that give a more attractive risk-adjusted return profile rather than just sticking with the generic stuff in the index. Next, in the bond market, I don't think a lot of central banks, other than Bank of Japan, has bought equities in part of their QE. In the bond market, oftentimes valuations in our space get tidal waved by non-economic investors. Look at the Fed. During COVID, they bought $5 trillion of bonds. Peter, when they were buying those bonds, they weren't trying to pursue alpha like I am. They were buying to stimulate the economy and to provide lubricant to the market. That creates distortions. You also have asset liability players who are buying bonds simply to defease and match a liability, not really generate a bunch of alpha. What that does is it creates distortions in the market that we active managers can take advantage of. Something as simple as agency mortgages. When the Fed did its QE during COVID, they bought so many mortgages, trillions of them, that they distorted valuations. We basically sold all of our mortgages, or the bulk of them, waited for prices to rebound, and then bought them back. That's something a passive manager doesn't do. Passive manager says, by the way, 2020 and 2021 was the largest refinancing wave America's ever seen. So guess what? More mortgages went in the index. At the same time Fed was buying them, the spreads were really not attractive at all, and you were forced as a passive manager to buy more of them. Doesn't make sense. And then finally, if you look at the corporate components of the ag or a corporate index itself, they're debt weighted, meaning you inherently lend more of your money to the most indebted companies. I'm a simple person. I always try to use analogies. Imagine if you and I started Dave and Peter's Bank, and our underwriting manual on how we give out loans was simply to ask customers, how much debt do you already have outstanding? And if they said, I've got none, we would say, you know what, you're not for me. You're not in my index, if my analogy is not clear.
Yes.
If they say, I've got a ton of debt already, I just need more, we'd give them a big loan. It's the opposite of how you should lend your capital. So we think we're actually past the point of peak passive, right? So I think a lot of people are now embracing this bonds are different narrative that we've been championing for 5-10 years, or even longer. But I think peak passive was probably during those low rate environments of COVID, right? 10-year treasury, 50 basis points at ag yielding less than 1%. Maybe people are like, I'll just camp out on passive. And maybe I get that, maybe I don't. But right now you've got a dynamic where rates are higher. There's a lot of uncertainty in the market, right? Think about what's going on. Like, what's the next presidential policy going to be? What's going on with the geopolitics? Are we done with inflation? Uncertainty breeds volatility, and you see it every day in the market. Look at the last 15 months. 10-year treasury has been 5%. That's been 350. That's been 470. That's been 360. Now it's above 4 again. So moral of the story is volatility, uncertainty, and the third element is dispersion. We've got the Fed cutting, we've got Bank of Canada cutting even faster than us, and you've got Bank of Japan hiking rates. So you've got major dispersion across the globe. That creates opportunities for an active manager. Like, we sign up all day long for volatility, uncertainty, and dispersion. That's a fertile backdrop for us to generate alpha. And if you look at it right now, you've got a lot of managers, some who are well-known passive managers who literally 5-10 years ago, I'd be on podiums with them and they'd be trashing active management. Now they're all setting up a cottage industry, launching more and more active funds, ETFs, mutual funds, in bonds. Because I think the math has illustrated that it does work. People are willing to pay for extra performance. And this is a target-rich environment for active management, in our opinion.
Well, there's 2 points that you made that I think are the things that flipped it for me. Because as I mentioned, my first exposure to bond funds were ETF indexed fixed income products. And that was great. That got us very diversified. It was very liquid. Those were the benefits of using those products. But it was the fact that not everybody's trying to maximize profit. When people go to buy stocks, they're trying to make money. Whereas, as you pointed out, an insurance company might just be matching assets and liabilities, or a pension, or like you said, the Fed. The other thing, though, is like the debt weighting. Like, if you and I go into a bank and ask for a loan and I have more debt than you, they're going to give me more money than you. That just doesn't make sense.
Opposite way to work.
I think there's a place for any product based on situation, but that's really what changed for me when thinking about the active conversation. Also, the fact that, yes, you pay a little bit more for active management, but the costs have still come down dramatically.
Yes.
And I think in general, I don't want to oversimplify your job. You oversee a lot of money. It's a lot of hard work, but at the end of the day, there's a lot of math involved that, yes, there is still some prediction, but you can deduce what return should be based on just some simple math. And why sit there and take the bad math when you can see the good math sitting right there? I really appreciate that opinion. One thing that I think will be nice for people who do utilize an active manager is when there are unexpected events. Now, I'm going to put a timestamp on this question in case any of us look silly. It is October 29th. We don't know who our next president's going to be. So this is a question, David, that has no political tie to it. So trust me when I say that. But a big topic that comes up, regardless of who's in office, regardless of who is in Congress, is the national debt. And as the national debt has grown, we've never seen a failed auction. In my perception, as a portfolio manager, you probably can't say one way or another, but I get the feeling that the Treasury just calls the portfolio managers directly before they have a failed auction. So if you're a bond investor and that's your big concern is the country's debt, what would you say to those people? I'd love to know, one, how you think about it as you're managing a portfolio, but then going all the way down to the end investor, how should they feel about their bond allocations? Because I talk to a lot of people who feel like if I own bonds and the national debt leads to a failed auction and interest rates, so I'm going to lose a whole bunch of money.
Yeah.
Big question.
No, I get it. And it's an important one, right? We're talking about the US here. Our debt dynamics look very questionable. And neither a presidential candidate nor anybody of significance running for Congress has articulated a viable plan to get it under control. That doesn't sell votes. So it's very hard to see the path forward. Let's just look at some math here. We're running 6 to 7% annual deficits. right? And that's in peacetime, not wartime. And that's when the economy is growing above potential. I said earlier, we grew 3% last year and over 2.5% in 2024. Yet we're still running 6 to 7% deficits. That's not good. Our debt to GDP as a country is well over 100% right now. And by our projections and the CBO's projection and most other people's projection, the next 15 years, it's going to get above 180%, closer to 200%. I believe the Social Security actuaries, and I'm a former actuary, so I sympathize with them. I think they've started ringing the bells and saying, look, at some point in the next 9 to 10 years, we're going to have to prioritize payments where we can't pay par on every Social Security guarantee we've made. So that's a challenge. And like I said, nobody in Washington has articulated a grand plan to tackle it. And unless we tackle entitlements and other issues, we're going to have a tough time getting that cut down. So let's talk about this. Is it a big problem? Yes and no. In my working career, in my lifetime, it seems hard to figure out how this is going to end ugly because the US dollar is the world's reserve currency. As important, if not more important, the US Treasury is the world's reserve asset. US Treasury is the world's reserve asset. Like I said, go look what happened when the yen carry trade blew up a couple months ago. Everybody bought treasuries. Look what happens when hot wars erupt. People buy treasuries. Next, we have the largest and most vibrant economy and most adaptive economy, right? Most innovation, most high rates of productivity, best rule of law in our economy, and then pair that with the largest and strongest military, we could get away with degrading our balance sheet longer than most of us Americans would like to see us do.
Right.
Because you can't replace something with nothing, right? That's a very obvious statement. So what is going to knock us off our perch? Hard to see. Now, that doesn't mean we just sit back and say, it is what it is. We try to position our clients' assets to take advantage of what we think will be the market reaction to these unsustainable deficits and debt levels. So first, curve steepeners. What do I mean by that? If we continue to degrade our balance sheet, yet foreign investors and people have to continue to buy treasuries, like think about if you're a big exporting nation, you got to soak up the dollars you collect on your exports and something you buy treasuries. Well, guess what? If you're worried about the long-term dynamics of the US, you're not going to buy a 30-year treasury, but you'll buy a 3-year name treasury.
Right.
So we've been positioning our clients for a curve steepener, meaning the long end goes up, mainly belly to the long end. And that's worked incredibly well. If I was talking to you back in April of this year, the slope between a 5-year treasury and a 30-year treasury was 5 basis points. Now it's almost 50 basis points. So moral of the story is that's something an active manager can have a view on. And it's not a huge risky trade like I'm buying some company that might go to zero. Just if we reflect on the margin, where you think there's going to be pain in the yield curve. Next, with heavy treasury issuance, guess what happens to that passive investor? We just talked about it. If the government is issuing more and more treasuries and they're issuing longer and longer treasuries because they want to term out their debt, you, the passive investor, are along for the ride. You're doing the opposite of what I just told you we did at PIMCO. You're buying those longer treasuries and you're buying more and more of them. And finally, this is an important one for active managers, especially active managers who believe in like our style of approaching, like bottom-up value investing, diversification. If we're running 6-7% deficits in years where we're growing above our potential in peacetime, that leaves very little, in our mind, tolerance and appetite to do counter-cyclical measures next time we get into a recession. So one of our biggest theses is, given the inflation fight we went through, right, where both the Fed and Congress had a little bit of pie on their face for exacerbating the inflation problem we had coming out of COVID. They didn't cause it. Supply chains did, reopening of economies did, revenge spending did, but they certainly exacerbated by buying, in hindsight, doing too much stimulus, leaving out there too long. So 1, stimulus caused inflation. 2, stimulus is the reason why we have north of 100% debt to GDP. We need to back off on that. So in the next recession, we'd be willing to bet a lot less counter-cyclical impulse out of the Fed in Washington to save the markets. That's perfect for our style of investing. Usually up in quality, up in liquidity, diversified, going where relative value is, not just buying more and more generic credit beta. So we actually welcome that environment. It actually exacerbates that uncertainty and volatility I talked about and dispersion. If the Fed's in the markets, kicking everything back to the middle of the field every time the ball gets near the sidelines, that doesn't really favor our strategies. You may as well go buy a bunch of the weakest bonds you can find out there because there's a safety net below you. We would be willing to bet that safety net is way, way, way below us versus history.
Well, and so let me paint a scenario for you and have you react to it. Because this is a scenario that I have prospective clients and clients bring to me all the time. And they picture there's a default on the debt. So first of all, really hard to picture that the Treasury doesn't just print the money needed to pay the interest. But okay, debt defaults, interest rates rise. And then the other scenario they're worried about is, well, if that doesn't happen, we inflate away the debt by just printing off dollars and making it go away. In either case, as an investor, there isn't like a safe place to hide And so, I hear people reference gold, for example. That might be a temporarily safe place to hide, but it's one of those bets where you can remain wrong for way, way too long. This is a crisis event. And sometimes when you prepare for a crisis or you invest for a crisis for decades, you're not going to do as well as if you just stayed invested. I have a hard time believing that you really would abandon bonds because of that view. If anything, I think this is probably a case for active management in bonds or these crisis events. And I do feel like that's why you own stocks too, because if all those things happen, I feel like the CEOs of Coca-Cola and McDonald's are still going to try to sell Coca-Cola and cheeseburgers. So how do you feel? Like, react to me. Tell me where I'm wrong. Tell me I'm right.
So look, we're American taxpayers. I have 3 young children. I don't want them to see the way this could end 20, 30 years on the road. But look, it is what it is. And in the near term, there's no viable option to replace the US dollar and the US Treasury, right? Through my working career, I've heard things like gold. Go look how much has been mined and will ever be mined. It doesn't really work with the size of the global economy. Then I heard things like the euro. Maybe they did a monetary union with no fiscal and military. Perhaps if you did all 3, you could have made that work. What else have we heard? Crypto? No, I don't think so. And then there you go. So what are we going to replace it with? And you see in times of stress, people still, in good times, they trash what we're doing with our deficits. They trash the problem, the debt to GDP. But in bad times, they run to the dollar and they run to treasuries. I'm not saying it's right. I'm just saying it is what it is. It's still the safe haven asset. And in fact, if you go back, the U.S. Treasury is no longer AAA, right? We've got a AA plus by 2 rating.
The bond market didn't seem to really care.
It's kind of like, if we're not AAA, well, what is, right? So I know various investors, us included at various points in time, have had the view that like that's going to be an event that triggers a command for risk premium for treasuries, and it never happened, right? So I think that's what you have to recognize until there's something viable to replace it with. And look, these levels we're talking about, none of us like it, but it's not like it's absolutely insane where we're like 200% debt to GDP, right? It's still relatively tolerable. And look, if we get growth picked up, perhaps it becomes less and less of an issue. We get some fiscal discipline in Washington, probably not till we have to, right? So as we get closer to the Social Security actuaries saying, I don't have any money left, that's probably when we'll do action, right? We'll do action at the last possible time.
Right.
Because like I said earlier, it doesn't really sell votes to campaign on, I'm going to fix this 10 years before it's a real problem.
Yeah. Each party's just hoping that the other one's holding the bag, I imagine. Well, let's go to the future trends of fixed income investing. What do you think our listeners can expect to see in coming years? And I don't necessarily mean in like returns, but is there any innovation, or if you have return views, by all means?
No, so look, I kind of actually think like the old boring stuff is hot again, right? So I just gave you the yields earlier in this segment about bond markets, like the index itself, 4.5, an active manager trying to beat the ag index, 5.5, maybe up to 575 or 6, and then a more multi-sector credit fund, like our income fund, or P yield, our other ETF that's more multi-credit, that's more like 6.5%. Look at those yields on history. Those are pretty darn attractive. I deal with a lot of institutional clients. I was in one client's boardroom and they said, do you know the crazy stuff we were doing for most of the post-Great Financial Crisis period to get 5.5 to 6% yields? It was private vehicles, multi-year lockups, way down in rating spectrum, subordinated. You could get that in a high quality liquid public fixed income fund right now that's actively managed. Like, how greedy are we? That seems pretty darn attractive, right? Most people think inflation is still 2.5 or below eventually once we get done with this fight. So those yields, you're still getting 200, 300, 400 basis points of positive real yield versus the inflation. Now, again, starting at S&P levels and PE multipliers at these levels, all-time highs, we think bonds have a really good chance of hanging close in total return to stocks over the next few years, if not beating them at 1/3 the volatility. So kind of what's old is new again, right? And if you think about, we went through a once in a lifetime period, right? The rates we saw in 2020, 2021, I never thought I'd see. 50 basis points on a 10-year treasury in August 2020. And that was considered attractive because other countries had negative rates. So what happened? What did we do as a financial industry? We created new products, a lot more private vehicles, lockup vehicles, more mezzanine floating rate structures to get the retail investor and the institutional investor some more yield out of their bonds, right? We engineered all these new products where so much money is going into private credit. Then when we had the first inflation fight in 40 years, we had a lot of floating rate products, like get out of bonds, get in a floating rate, maybe going to cash, but how about this floating rate thing that has some spread on it? Well, a lot of those have credit exposure in there that's kind of down in the capital structure, much more closer to taking a loss if we had a recession. So the two main products to generate yield, private lockup vehicles and floating rate vehicles to get through that 4-year period, we think have more headwinds to them than just a good old-fashioned, boring, high-quality core bond fund. I mean, it's almost odd to think about that, but that's how we're thinking about the world. And then the last thing I'd say, an emerging trend is I can't emphasize enough that given the inflation fight we went through, that's not going to be forgotten anytime soon. You're younger than me. I entered working in the 90s, and I remember the folks who trained me in this business saying, kid, you missed it all. The Fed knows how to tame inflation. All the fireworks in the bond market was in the 70s and 80s. Go do something else. And I stuck with it. And here we go. We had a 1 in 40-year fight against inflation. And it's, again, because we stimulated so much, $5 trillion of quantitative easing, 0 policy rates for several years, $6 trillion of fiscal stimulus to fight COVID. We had to do it, but we did too much in hindsight, left it out there too long. That caused inflation, right? Like John Maynard Keynes talked about deploying government stimulus to smooth the business cycle, but he said, be careful because it might stoke inflation. Don't do too much. Don't leave it out there too long because it might cause inflation. Well, guess what? We did stimulus during the great financial crisis. We didn't cause inflation. We're like, oh, this is easy. I could get the good side of smoothing the business cycle, but not get the downside of causing inflation. This time we stimulated, we caused inflation. We would really argue there's going to be a lot less counter-cyclical stimulus being deployed to smooth the markets. So you want to hire an active manager who is diversified, not just relying on credit beta to get your alpha, but spreading it around the market, up in quality bias, up in liquidity bias, and going where the opportunities are.
Well, I'm with you on that one, David, and maybe a future episode for me is going to have to be how do you pick your active fixed income manager, but
Love to be part of that one.
we only have a little bit more of your time though, so you're so knowledgeable in the bond and fixed income space. It's a misunderstood area by a lot of individual investors. If there was one thing, one misconception, or one idea that you could make sure that all individual bond holders had, what would that thing be?
Yeah, this is where I'll show my nerd side. It's bond math. And what I mean by that is when rates go up, multiply the rate move up by your duration. That's probably what you're going to see for your account value going down. So rates go up and you take it on the chin. We saw that in 2022. And I already tried to articulate the problem with 2022 is we started with low yields. Yep. So there was no forward momentum to offset that capital appreciation when rates rose 400 basis points. That's the past. And sadly, we as humans always run from the last fight we lost, and we all lost that fight. Now look at the bond math. Now you're getting 4.5 to 6.5% yields on high quality bonds like I've already talked about. That's your forward momentum. So unless you're in the camp of calling for meaningful rise in rates, I'm not talking 25 or 50 basis points, maybe not even 100 basis points. Unless you're calling for like 150, 200 basis point rise in rates, you've got forward momentum to dampen the drawdown if we do get a marginal rise in rates. That's very, very important. Like when I think about this, you know better than me, a lot of retail investors are very comfortable buying the dips in stocks, right? We hear that all the time. I'm not a stock guy. I listen to CNBC and Bloomberg TV, and I was like, oh, buy the dips, buy the dips. Nobody does that in bonds. They do the opposite. They open up their muni statement or their bond statement, like, oh my God, I lost money on a high quality bond fund. I'm selling. No, that's when you should be buying. You lost money because rates went up. That higher rate level, which hurt you last month or last year or in 2022, is now your friend. That's your tailwind that should drive future returns. We have a chart, it's in one of our website pages, that shows the starting yield of a bond fund, of a high quality bond fund, not a low rated where you can take defaults, but a high quality bond fund. The starting yield has a 94% correlation over history to your forward 5-year total return. And like I said, we're at the most attractive starting yields in almost 20 years. And we've got growth slowing. We've got the Fed cutting rates. We've got stock prices elevated. We got recession risk rising. We got volatility events coming ahead with what's the next Congress and president going to try to deploy for policy. We got geopolitical challenges. This is all a conducive, attractive environment for bonds, and you're getting paid a nice fat starting yield to get involved in bonds. So it would be that. Try to understand bond math. Try to get a mindset of buying the dips in bond markets, like you retail investors do in stocks. Try to do that in bonds as well.
Great advice, David. I'm going to make sure that I have all those things that you're referencing linked in my show notes at thelongterminvestor.com. I even feel like I know exactly what chart you were referencing at some point, so I should be able to run and grab that real quickly. And I do think that people don't really realize how unimportant over the long term the fluctuation in the price of bond funds really is to the return. It's the income you earned and the compounding of that income being reinvested. And really go check out this chart. It's a phenomenal chart where you can see it very, very clearly. I think it's one of these areas, if you spend a little bit of time on, you can be a much, much, much better investor. David, again, thank you so much for your time. Really appreciate it. To all of you listening, watching, rate, review, subscribe, like, do all the things that help more people find this information, because we want to have David's words spread, help other investors. And so by doing that yourself, you are in fact making somebody a better long-term investor themselves. So thanks again, and we will see you next time.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.